Welcome, and thank you for joining us today for a brief introduction to your company-sponsored retirement plan. TrustPoint was carefully selected by your company to administer your retirement savings plan. Both your company and TrustPoint are dedicated to helping you understand how your retirement benefits work. The more you understand how the plan works, the more prepared you will be for a secure retirement. Over the next 12 minutes, we'll go over the highlights of your retirement savings plan. Before we get started, let's take a look at your retirement future. Do you ever think about where your money will come from when you stop getting a paycheck, or how much money you will need for a comfortable retirement? Most of us are painfully aware that Social Security will not be enough to live on. In fact, for most Americans, Social Security will only replace about 40% of their income, which means that you have to provide the rest. So how much should you have saved in order to retire comfortably? A recent industry study determined that to replace 85% of your current income every year in retirement, you would need to have 8 times your ending salary saved by the time you retire. To reach that goal, they suggest that you have 1 times your annual salary saved by age 35, 3 times by age 45, and 5 times by age 55. We all have plenty of reasons not to save for retirement, but no more excuses. Saving for retirement is something everyone has to do because, you just heard, Social Security alone is not enough to provide for your retirement. That's why it's so important that you take responsibility for your retirement. Even if you start small, just do something, because there's a huge cost to waiting. Let's say that you start working at a job when you are 22 years old, and you have the wisdom to start saving right away for retirement, and you commit to save $100 a month, no more, no less. But more importantly, you never stop contributing until age 65. With an 8% rate of return, you would end up with about $412,000. But most of us don't start saving right away because retirement seems so far away, and there are plenty of other things we'd rather spend our money on. But if you wait just 5 years and start saving at 27 instead of 22 and commit to the same formula, $100 a month, no more, no less, but more importantly, you never stop contributing, at age 65, you would end up with about $275,000. Which is still a lot of money, right? But what was the cost of waiting? $100 a month times 12 months times 5 years. The $6,000 that was not invested from age 22 to 27 had a negative $137,000 impact on your retirement. That is the time value of money and the magic of compounding. Some of the benefits of using a 401k plan is it's really easy to save for your retirement. The money comes right out of your paycheck. You are paying yourself first, and once you start, you won't miss what you don't have in your check. It might not cost you as much as you think because you won't pay taxes now on the money you put into a traditional 401k until you take it out at retirement. And 401k accounts were designed to be portable, so you can take your retirement savings with you if you leave your current employer. Enrolling in your 401k plan is simple. There are only 4 decisions that you have to make. The first decision is how much. The second decision is how do you want the money to come out of your check. The third decision is how do you want TrustPoint to invest your money. And the fourth decision is who do you want TrustPoint to give your money to if something happens to you. Over the next few minutes, we will help you answer these 4 questions. The first decision is how much. The rule of thumb is that people should aim to save 10%. That may sound like a lot of money, and many of us can't do that right away, but start small. And then get in the habit of increasing your deferral by 1% each year. Or if you get a raise, increase your deferral right away. It's a great time to do it because you're not used to having the extra money in your check. If your company offers an incentive for you to save for your own retirement in the form of matching dollars, baby step number 1 in saving for retirement is to get as much free money as the company is willing to give you. If there was a great big pile of money sitting in front of you and you were told you could have it, would you say no? That is what you were doing when you were not taking full advantage of any employer matching dollars. The second decision is, how do you want the money to come out of your check? All plans give you the option to defer your contributions pre-tax or before taxes, which is the traditional 401k, and some, but not all plans, let you choose to contribute after-tax dollars, which is the Roth 401k. Saving into the traditional 401k will have the least impact on your paycheck because you won't pay taxes now on any money that you contribute into your 401k account. All of your contributions and earnings grow tax-deferred, which means you will postpone paying taxes until you take the money out at retirement. With the Roth 401k, you are not going to get a tax break now on what you contribute, so it will cost you a bit more. But the benefit is that all of your contributions and earnings will be tax-free to you at retirement. As you can see from this biweekly paycheck example, your pre-tax contribution comes out before taxes, so your $60 contribution only costs $53 because of the tax savings. With the Roth, you pay taxes on the $60 you contribute to your 401k. The biggest question you have to ask yourself is, do you think your taxes will be higher when you retire or lower when you retire? If you think your taxes will be higher when you retire, then you might want to pay the taxes now. If you think you will be in a lower tax bracket when you retire, then wait and pay the taxes as you take the money out during retirement. Those that benefit the most from the Roth 401k are younger workers, because the true benefit of the Roth 401k are the years and years of tax-free earnings growth. Regardless of whether you choose the Roth 401k or the traditional 401k, employer contributions and earnings will be taxable as income when you start drawing the money out at retirement. The third decision is, how do you want TrustPoint to invest your money? For most people, having to decide how to invest their money is the scariest part about their 401k plan, but we're going to make it very simple. Inside your retirement plan, you will have two basic options. You can choose from profiles, which are portfolios that TrustPoint manages and will make all the decisions for you. You simply choose a profile based on how much risk you are willing to take. They are risk-based portfolios. Or you can build your own portfolio and choose from a list of individual mutual funds that have been carefully selected for your plan, and you make all the decisions. Let's talk briefly about some very basic investment concepts. All investments have risk, and there is a direct correlation between risk and reward. There are two basic types of investments: stocks and bonds. With stocks, you're an owner. So if you have 100 shares of McDonald's stock, you are a very small owner in McDonald's. With bonds, you're a loaner. You're lending your money to a corporation, to the government, or a municipality. They promise to pay you interest or income for a specified period of time and then give you all your money back, much like a CD at the bank. With stocks, you make money when the company prospers and the stock price increases, as well as when dividends or profits are paid to the shareholders. With bonds, you earn interest or income over the duration of the loan. When you are selecting your investments, it is very important that you remember that stocks are considered riskier than bonds. Now, we don't want you to think that bonds don't have risk. They have different types of risk than stocks, but the basic concept is stocks are considered riskier than bonds, so the more stock exposure you have, the more risk you are taking. As we previously mentioned, the profiles are risk-based portfolios. Each profile has a predetermined range of stock and bond exposure, which helps you determine the amount of risk you might be taking. Depending on market and economic conditions, TrustPoint will increase or decrease the allocation to stocks and bonds. For example, in the high-growth profile, the stock allocation can be as low as 80% stock or as high as 100%. It will never exceed those parameters. The most conservative profile is the fixed income profile. Fixed income is another word for bonds. It is an all-bond portfolio. It will never have stock exposure in it. The conservative growth profile is more bonds than stocks. The balanced growth profile is about half and half stocks and half bonds. The moderate growth is more stocks than bonds, and the high growth profile is the most aggressive and almost all stocks. The theory is the further away you are from retirement, the more risk you might want to take, but only if you are comfortable with it, and then start getting more conservative as you get closer to retirement. TrustPoint takes a risk-based approach to investing because everyone has their own personal risk tolerance, which is your ability to weather the ups and downs of the market. When you are selecting a profile, you will need to consider how much risk you are willing to take. We have talked about how much, how do you want the money to come out of your check, and how do you want TrustPoint to invest your money. Now, the fourth decision you have to make is who to give your money to if something happens to you. The primary beneficiary is the person or persons who are first in line to receive your money. The contingent beneficiaries inherit the money if your primary beneficiary dies before you, or if the primary beneficiary disclaims the inheritance. Very important. If you are married and not going to name your spouse as your primary beneficiary, he or she must sign the beneficiary designation form in front of a notary, acknowledging that they are aware that they are not your primary beneficiary. If you are not married, you can name whomever you want, but it's really important that you keep your beneficiaries up to date because these designations will override a will or a trust. There are only 3 forms that you need to fill out to sign up for your plan. The salary deferral form lets payroll know how much and how it should come out of your check. The investment election form tells TrustPoint how do you want your money invested, profile or individual funds. And the beneficiary designation form designates who TrustPoint should give your money to if something happens to you. It is really that simple. At TrustPoint, we have had the privilege of helping people retire for over 100 years. You can never have too much money when you retire, so please take advantage of this great benefit that your company offers to help you achieve your retirement goals. For additional information about the plan or to request enrollment materials, please contact your plan sponsor or call TrustPoint, and we will be happy to address any questions or concerns that you might have. Thank you for your time today, and we look forward to helping you achieve a financially secure retirement.